Okay, in this segment of the video series, we're going to cover some basic ideas associated with portfolio risk and return. The entire topic of portfolio and the risk and return concepts associated with the portfolio process and portfolio management is going to be in two parts. This first part will be really some of the basics in calculating returns and some of the basics associated and getting around the general portfolio concept. And then part two, we'll deal with some a little bit more intermediate ideas about some asset pricing and stuff like that. But for the moment, we're going to just stick with a little bit of some of the basics. There will be some calculations in this section, so but they're relatively straightforward and pretty easy. So you shouldn't have to worry too much about them. So with that in mind, let's go ahead and get started. All right. So the first idea that we want to talk about whenever we're talking about portfolio or any kind of potential investment is to come up with a return. How do we calculate a return? Well, holding period return is essentially what you should understand is whenever we're talking about a holding period, there's an ending and then there's a beginning. All right, and so this holding period return formula that you see there is nothing other than we have an ending period and we have a beginning period, and we take the value at the end and we take the value at the beginning. We do a little bit of algebraic manipulation, and boom, out pops the return. So the idea that I want to show you here, and let me see if I can make sure I get this tool to work correctly here. Idea that I want to show you is that whenever we're talking about these returns, I mean, really, the formula that you see on the screen is a little bit of a shortcut, all right? And so what I'm going to do is just give you kind of like a fundamental relationship, which always works no matter what way you're thinking, right? So we have our ending value. Okay, we subtract our beginning value, and a little caveat here: we might have a little bit of a flow. All right, we might have a little bit of flow. I'm just going to give you kind of like the general formula, and which will always apply. And when we divide that by the beginning, that gives us our return, and that's not BEB, it's beginning. All right. All right. So when we divide that by the beginning value, okay, it gives us our total return. Well, the example that we have on the slide here is just assuming that we don't have any flow, or that any flow is essentially inconsequential. So what we're doing here is that when we talk about return, all right, when we talk about return, we really are just talking about the change in the value. Okay, we're talking about the change in the value over our ending time horizon, or the ending point of our time horizon, and the beginning point of our time horizon. Well, this is nothing other than, you can see from the formula, okay, this is end over beginning, okay, minus beginning over beginning, okay? Well, which is nothing other than end over beginning minus 1, all right, which is what you see on the formula. So I get the point I'm trying to get you to understand here is that this relationship, okay, this total return kind of concept is all encompassing in when we're calculating a return measure, in that there is a starting point, there's an ending point, and then there may be some intermediate change, or there may be some intermediate flow that we'd like to take into account whenever we're doing our calculation. So I just want you to keep that in mind, only because the standpoint is that is really how the R's are being calculated. That's the return number. All right. So what we see here is that if we have a series of returns that are in equal, they're equal time, ending minus beginning, or the same time period, monthly, weekly, annually, whatever the case, we can calculate an average return. Well, this particular average return has a special name. This is the arithmetic average, and this is the average that you probably have understood, or that you've probably seen for a long time period. All you do is you just sum up the returns, and then you divide it by how many you have. Well, that's a nice figure, in that it could give you an indication of a central tendency, but it's really not going to give you an indication of change in value from, if you started out with $1,000, what would you have ended up with at the end of the horizon. Well, excuse me, the $1,000, and then if you would have been able to compound those returns over each one of those particular time period, what would you have ended up over the ensuing 10 months, 12 months, 10 years, 15 weeks, whatever the case is? In order to be able to do that, you need to be able to calculate the geometric mean return, and that would be the average, quote unquote. That would be applied on a periodic basis to move you from the beginning of your portfolio value to the ending of your portfolio value. Whereas the arithmetic mean is a summation divided by how many observations you have. The geometric mean is a product of your returns taken to the nth root. Okay? It's a product of returns taken to the nth root. So when we're talking about geometric returns, we're talking about geometric returns. They differ from arithmetic returns in that it's a product and then you take a root, whereas arithmetic return is just a summation and you do divide by however many observations you have. Pretty straightforward, okay? Pretty straightforward kind of concept, which is fine, okay? Which is fine in getting us to understand. And getting us to understand some generalities about return measures. Well, the idea with the arithmetic and the geometric return numbers is that they lend themselves well to what we call a time-weighted concept. Well, of course, we have return in the first time period, return in the second time period, return in the third time period. We sum them up, get the arithmetic, or we add 1 to the return and multiply across and take the nth root, we get the geometric. Well, that's kind of like a time-weighted kind of concept. An alternative measure is a dollar-weighted or money-weighted return, and I'm going to see if I can just make sure. Sometimes you'll read this or you'll see this reference as a dollar-weighted return measure. Well, these dollar-weighted return measures are nothing other. Okay, they're nothing other than calculating an internal rate of return, which you've seen in your corporate. Which you've seen in the corporate finance section of this video series. And it's nothing other than trying to calculate the return number that sets this equation equal to 0. Now, there's a couple little items that you have to have. The periods have to be of equal length, and you should use the shortest period that has, with no significant cash flows to kind of define what your periods are. These dollar-weighted returns, and because they are quote unquote internal rate of return, this is how you would calculate the internal rate of return, which is the same idea of how you would calculate the dollar-weighted or the money rate of return. So, as an example, let's suppose you've got $1,000 at the beginning of the period. You invest in an account. At the end of the year, it's worth $1,200. You add another $800, and at the end of the year, the portfolio is worth $2,200. How would you calculate that dollar-weighted return? Well, that dollar-weighted return is nothing other than trying to formulate the denominator that sets each of the cash flows equal to 0. All right. Now notice what we have here. We have this $1,000 is the first cash flow. This $800 is the second cash flow. So we don't take into account the $1,200 value. We only take into account the flow that's being added to the portfolio. Okay. So the idea, that I think you need to recognize is that whenever you're doing these dollar-weighted returns, we really are focusing on the flow component, all right, the cash flow associated with the investment decision. But then the final one, the final period makes an assumption as if we would have done what? Sold. We would have sold the cash. We would have sold the portfolio, and that's the amount that we would have received. From a calculation perspective, or calculator perspective, I guess you should say, is that that's pretty easy, pretty straightforward in order to be able to do that calculation. And that the standpoint is that you enter the initial cash flow, you enter the first cash flow and the second cash flow, and you are essentially just computing the internal rate of return associated with that series that you are plugging into your calculator. And that's and every calculator is different. We're not going to focus on any particular calculator, but that's the idea. Hey, that's the idea. It would be the same way that you would calculate the internal rate of return of any cash flow associated with a corporate type of a project. So the idea is the same. Just think of the standpoint that we are formulating the denominator that sets this equation equal to zero, i.e. the value of the cash flows in the numerator equal to zero over time. Now, what happens in this particular example, because the $2,200, $2,200 is the biggest value, we get a little bit more weight on those second period returns than we do on the first and initial. So from that aspect, every calculation, every return, there's something not right about it, right? There's a little piece there that could be improved upon, but from that aspect, it's just really one of those deals where I think what you need to realize and understand whenever you're talking about different return measures is that you should know and understand the benefits and detriments associated with each. And from that aspect, the dollar weighted return is definitely going to place a little bit more weight on the heavy, or I guess the larger cash flows in a series. So that's kind of the idea that we want to do, that you want to remember from this section. Now, there are various ways that we can do these calculations. We can do the calculations on a gross aspect, a net aspect, an after-tax aspect, a real aspect, a levered aspect, etc., etc. And the idea is for you to remember, what do you take away from, I guess if you want to think about it, just the rawest, simplest number. Right, the raw simplest number from a valuation perspective. What do we need to take away in order to be able to get, to each one of these return measures? So a gross return is nothing other than that rawest number that we had, and with that would be the total return. That would be the end, over the beginning, minus 1. All right. So from that aspect, that's the gross return. Now, what we're doing from a portfolio perspective is that we're going to subject or possibly subject the portfolio to various fees. The gross return is going to be that raw return before we subtract management fees. Well, we take that gross return and then we subtract management fees and we get the net return. And then when we take that return and take taxes away, we get the after-tax return. The real return, we adjust that for inflation. The leverage return would be the return that we get on our cash investment. Assuming that we can do what? Assuming that we could borrow money, meaning that we wouldn't have to put the entire amount of the initial investment up. Okay. So from that, I think that's one way to think of it. Think of it as having like a really big fat number that has all of the quote-unquote value addition, subtraction, changes associated with it, and then we take little pieces off of it for fees, taxes, inflation, etc. Right? So as an example, let's see if we can kind of walk through one. An investor buys 500 shares at $35 with 50% margin, meaning that they put up 50%. They put up 50%, so there's the amount of cash that they put in is not going to be the entire 500 times 35. Okay? Or if you want to think of it on a per share basis, it's not going to be 35, it's going to be $17.50. Right? After 1 year, the shares are sold for $50. Right? So that's $15 change in value from the initial investment, but because of the standpoint that we didn't put in the original 35, that's going to have an impact on our return. Okay? All right? So we have a 15% tax on gains, and inflation over the year was 4%. If we ignore interest and commissions, we'll kind of forget about that right now. What's the investor's real after-tax levered return? All right. So the first thing we want to be able to do is calculate the levered return. Well, the levered return is exactly the same as our total return, except, so we have end, minus beginning, But in the denominator, it's not the beginning value, it's how much, it's our cash that we invested. It's our cash that we invested. So from that aspect, you can see how the 50% margin allowed us to lever up. And generates an 85.7% return. Well, after tax, that's going to be what? Well, we have our, and let's just assume we had $1, right? So, we just can't kind of keep everything in numerator, so we can just use the the percentages that we get. So this is the before tax number, and we subtract out the 15% tax rate, gives us a 72.8%. 72.8% after-tax return. From a real basis, okay, on a real basis, or not from a real basis, on a real basis calculation perspective, essentially what we're going to be doing, okay, essentially we're going to be discounting that 72% back by 4% over that one time period. Because inflation has kind of like a compounding effect, right? So in the first year, inflation was 4%. If inflation was 4% in the second year, it's not like you have 8%, okay, 8% effect, but you had 1.04 times 1.04. So the idea is essentially very similar from a perspective of a present value. If that dollar were worth $1.72 a year from now, okay, really what would have it been worth in today's terms? And that's where we get the 66.2% number that you see on the calculation, all right? So that's good, all right? I mean, or at least it's a basic kind of calculation, all right? It's a basic calculation, and at the standpoint that you have a real fat number, and you start taking away some pieces, and then you can make adjustments if you have leverage, inflation, taxes, etc. So that's the idea. But it really is based, or not really, it is truly based on the first principle of what? Taking that total return, ending minus beginning divided by beginning, etc., in order to be able to calculate the R, the total return number, right? Now, what we're going to do here is kind of make a little bit of a tangent, but we have to do this in order for you to get your hands prepared, or at least get your toolkit prepared to calculate some basic portfolio measurement figures. And what that means is we're going to kind of tangent off a little bit into some statistics, which you have also seen in the video series, but we just want to make sure we understand where we are. Let's suppose we have 2 assets and 3 years worth of data of those 2 assets, all right? We've got asset A that had a 5% return the first year, negative 2% return the second year, a 12% return in year 3. Asset B had 7, negative 4, and 18% respectively. Well, the mean, and generally speaking, when we do these calculations from a performance perspective, we do it in an arithmetic perspective. So that's nothing other than summing up each period's returns, and then dividing by how many periods we have. So in this particular case, the average return for asset A is 5%. The average return from asset B is 7%. I want to make a little bit of how would I say this? I just want to give an indication that you have to kind of be a little careful. I don't have as much of a, I don't know if I'm not as particularly about this, but sometimes some people are, and that standpoint is that you have to be careful whenever you're doing these calculations to either stay in the decimals or stay in the whole and the percentages, and that's really true. You have to make sure you stay in the same. If you're going to be in decimals or in percentages, all calculations need to be the same way. I have a personal preference to put everything in decimals. That's just my personal preference. Other people I know have a preference to put everything in percentages. Whatever the case, I recommend whichever route you use. You just need to make sure that you're following that same, and you're following the same units, okay, either in percentages or in decimal throughout your calculation. Because if you do any mixing, your calculations are going to be wrong. So, calculated the mean for each one. For asset A, it's 5%, and for asset B is 7%. And now we'd like to do is calculate the standard deviation. Well, the standard deviation is just the square root of the variance. It's just the square root of the variance. And so what we have here, and it's nothing other than summing up, okay? It's just summing up the individual observations minus the mean squared. Okay, that's all it's doing. All right, that's all it's doing, and dividing by n minus 1. That's all we're doing. We're taking each individual observation, subtracting the mean, squaring it, summing that across all of the observations, and then divided by n minus 1. So the variance that you see here for asset A is the individual minus the mean, individual minus the mean, individual minus the mean, and those deviations are squared. And then they're summed and then divided by n minus 1 or 3 minus 1. They have 3 observations, or 2. So that comes out to be a variance of 49. If you would have stayed in the decimals, you would have gotten a number of 0.0049. You take the square root of that, okay, and you get 0.07 or 7%. Same idea with the variance of asset B. You get 7 minus the mean, negative 4 minus the mean, 18 minus the mean. Each one of those deviations squared, sum those up in the numerator, divide by n minus 1, and you will get 121, or if you would have stayed in decimals, 0.0121. Take the square root of that, and you get a standard deviation of 11%. Why do we want to formulate that? Well, just hold the standard deviations in your pocket for a second, because that's going to come into play in an overall portfolio context in just a second. But for now, the next piece that we want to do, so what have we done? We've calculated the mean, we've calculated the variance, and now what we're going to do is calculate the covariance. And the covariance is nothing other than a measure, an indication of the measured direction of movement, of co-movement. Well, I'm going to give a little foreshadowing here. Covariance is a good indicator of direction. It doesn't really give us an indication of strength of that co-movement. So that's kind of the idea of what we'd like to do and how we're going to be able to do that. And we're going to get that strength, we're going to get that strength through the concept of correlation, all right? But co-movement or covariance, all right, is nothing other than, and let me make sure I get my, nothing other than each observation deviation from the mean, each observation deviation from the mean multiplied across all of the observations and then divided that by n minus 1. So you see that for asset A, and I'm just going to put a little bar here between each one of these to make sure that you see that it's between asset A and asset B. So we have the first observation for asset A, and then we've got the mean. We've got the second observation for asset A, then we've got the first observation, sorry. Let me back up. Yeah, let me clarify that. Okay, let me clean that up. Okay, xi minus x bar times yi minus y bar, where the bar is the mean. We sum that up, n minus 1. All right, so I'm going to, again, go back and draw a kind of delineation. So this is the first observation for asset A and its mean, the first observation for asset B and its mean, the second observation for asset A and its mean, the second observation for asset B and its mean, the third observation for asset A and its mean, and the third observation of asset B and its mean. Each one of the deviations of each observation are then multiplied, and so that gives you an indication of co-movement. What you'll see is whenever you have, and we divide that by 3 minus 1, and we get we get essentially a positive number, right? A positive number. What this indicates is that on average, when asset A is above its mean, asset B is above its mean. When asset A is below its mean, asset B is below its mean. It just means on average. It doesn't necessarily mean that it's always the case, but you can see that in the first case, both of them are below the mean at the same time. In the second case, they're below the mean at the same time. And in the third case, they're above the mean at the same time. Well, I take that back. The first one is they're not below, they're at their mean, right? So this is essentially 0, right? Essentially 0. So they're right on, or they're above, or they're below, right at the same time. And that's kind of the idea of what covariance is indicative. It gives you a sense of direction relative to the asset's mean, at the same time period, at the same time period. But a 0.0077, or in 77 in percentage terms, what does that mean? What does that mean? It just means that they tend to move in the same direction relative to the mean at the same time, on average. In order to be able to get an indication as to the strength of that co-movement, we want to be able to calculate the correlation. And this is a formula that's highly recommended that you put in your head from the standpoint that you should recognize this formula. And that the correlation, the correlation is nothing other than the covariance, which what we just calculated, divided by each asset's standard deviation. So that's why I said, why were we calculating the standard deviation? Well, we're calculating the standard deviation so that we could standardize the covariance. And we want to standardize the covariance so that we can get a measure of strength. And correlation, correlation is bound between -1 and +1. We either have perfect negative correlation or perfect positive correlation. Those are the boundaries of correlation. And those are the boundaries correlate. Can't be outside of that. If you get outside and you calculate a number of 1.7, you have done some calculation incorrect somewhere. So that's an indicator, and that kind of like a self-check about the calculation. When you do correlation, if you get a number outside that boundary of 1, then you need to go back and redo the calculation because it's incorrect. All right. So the idea here is that we do the calculations to get 0.0077. Now notice the covariance in the numerator is what? It's in decimal terms, and the standard deviation is the denominator in decimal terms. Make sure you stay in the same units. Okay, make sure you stay in the same unit. Again, I will indicate to you that my preference, and always, I think it's always better, because essentially when you're doing any nonlinear work, meaning you're cubing or squaring or dividing and multiplying, it just makes it, I think it's just better for you to stay in decimal than in percentages. But that's my personal preference. And so when we do that, we find that these particular assets are perfectly positively correlated. They're moving in the direction at the same time very strongly. Well, I mean, it's perfect positive correlation. So if you plotted them on a line, you'd have a straight 45-degree line, right? So when we talk about portfolio, and we're talking about portfolio, right? I mean, so that's some basic concepts, right? Basic concept of return, basic concept of mean, which usually indicates, how would I say, mean, indicates expected returns, okay? Indicates expected returns. So from that aspect, what you should recognize is that we are calculating these numbers, we're calculating these statistics to get indications of something, okay? To get indications of something. And that indication of something is that from a portfolio perspective, you never really never have all your assets. You never really hold only one asset. You have lots of different assets, all right? So we calculated the mean, we calculated the variance and standard deviation. The standard deviation is nothing other than what? The standard deviation is just the square root of the variance, all right? We calculated covariance, which indicates what? Code movement, right? But we don't know what the strength is. And then we calculated correlation, which gives us an indication as to the strength of the movement. Well, we can calculate the two main characteristics of most assets that most investors, from a portfolio perspective, okay, are concerned with, and that is the mean and the standard deviation. Or in general terms, we would call the returns the good stuff, and we call the standard deviation the bad stuff. Essentially, the returns would be the rewards, and the standard deviation would be the risk. So what we'll see here is the average returns, okay? We see the average returns over a long time period associated with various different asset classes. Small cap equity, these are equities, okay? These are equities, okay? And then these, of course, are bonds, and then very risk-free bonds, bills, and then just inflation. What you tend to see, or what you should, I guess, what you should see is that there tends to be, and this is kind of one of the fundamental paradigms in finance, and that's that risk-reward trade-off. The higher the return you get, the higher the reward you get, the more risk, or the more risk you have to take to get there. Technically, risk drives return, not the other way around, and we'll see that later in a slide, and we will also see that in spades when we get into part 2 of this topic area. So what you see is that returns along, and now these are being ranked according to returns, right? Declining returns. You see small cap equity generates the highest return, and that inflation generates the lowest. Change in value is 3%. You also see a somewhat decline, almost linear, but it's not. There is a little bit of a deviation right here, okay? A little bit of deviation between long-term corporate bonds and long-term treasuries. Okay, but generally what you'll see is that the greater the return you have, the higher the return you have, the higher the standard deviation. Okay, and that the lower the return you have, the lower the standard deviation. All right, so and that's in general senses, not always one-to-one, and depending upon which period you use, it might be a little offset there. Okay, it might be a little offset, but generally you should recognize and understand from a portfolio perspective that what you are trying to do is not choose only return and focus only on risk. You have to take into account both of them. And when we get into a portfolio perspective, we take into account both return and risk, and when we make a portfolio, that co-movement will come into play, and I'll show you what I mean by that in a couple of slides. All right. Another aspect that we have to take into account from an investor's perspective is this concept of a risk aversion. Risk aversion essentially is nothing other than if we have the choice between a sure thing, and a risky thing, and they're both going to generate the same expected value, we're going to go with the sure thing. All right. So, and then if we have a choice between two assets or between two investments that generate the same quote unquote return or the same goodness, we'll go with the one that has the least risk. And the reason for that is that we're risk averse. We would prefer, to get things without taking unnecessary risk. That does not mean, and that does not mean that investors who are risk averse minimize risk. What it means is that you have to understand the trade-off between risk and return. And so the idea that I always try to tell candidates and students about is that if you have the same expected return, that's the same reward, i.e. the same goodness, all right, the same goodness, you're going to choose the investment that has the lower risk. Okay, you're going to choose an investment that has the lower risk. Because think of it this way, you can get an investment of 17% rate of return. But the first investment has a standard deviation, i.e. an indication of spread around there, an indication of how you might not get that 17% of only 10%, and asset B has one of 35%. Well, that 35% means that there's a greater opportunity that you're not going to get that 17% relative to the first investment. So you'll choose that first investment. On the other hand, if the two investments have a standard deviation, which we will name as our metric of risk, of 25%. Now, what you're going to want is you're going to want the asset that generates the higher expected return. So you know you're taking risk, and this is the amount of risk that you're taking. Well, don't get $5, get $7, right? Something like that. That's the idea. Or in return perspective, don't settle for 10%. Go ahead and get another asset that generates 12% because of the standpoint that they both have the same level of risk. Okay, they both have the same level of risk. Get the one that gives you the higher benefit. Get the one that gives you the higher benefit. So that's the idea. Okay, that's the idea. So what you should recognize, is risk aversion does not mean risk minimization. And it does not mean no risk. It means that whenever you are making a decision, you have to take into account both return and risk. So here's a problem that you might want to think about. Abner is risk averse. Which of the following statements is most likely correct? He will choose relatively safe investments. He may hold some very risky investments. His risk tolerance is relatively low. Risk aversion doesn't say that he's going to only hold. Doesn't say that he's only going to hold relatively safe investments. I mean, he might, but the issue is that he's probably going to have some risky investments because of the trade-off that's involved. The trade-off involved, and we really, we're really not making a statement about specifics about risk tolerance at this stage. So the idea is that just understand that when we're talking about risk aversion, we're taking into account both return, the benefit, the goodness, and risk, standard deviation, the quote-unquote bad outcome. The bad outcome. Now, I indicated a couple slides ago that when we talk about a portfolio, we're talking about combining various assets. And this is an example of combining two assets. All right, we have asset A and we have asset B. And one of the things that you should recognize, is that when we are trying to calculate the risk, the standard deviation of the portfolio, we take into account the standard deviation of each asset, but we also take into account the measure of co-movement amongst these assets. So that's the reason why I spent a little time whenever we walk through the slides to get you to really understand what is it that covariance and what is it that correlation are indicating. They are indicating strength of movement. They're indicating strength of movement and direction of movement. So what you should realize is that the formula I told you that you should need to remember is that the correlation is equal to the covariance divided by the two standard deviations. Well, that means the covariance is equal to the correlation times the two standard deviations. So you can substitute in any portfolio standard deviation calculation, all right, if you have the covariance figure or if you have the correlation figure, all right, you can actually calculate, okay, you can actually calculate the portfolio standard deviation. So what you should see is that there's going to be three main components, all right? Okay, three main components. The variability of your assets, excuse me, I wanted to do that. The variability of those assets, the weightings of the assets, okay, the weightings of those assets, and how those assets co-move. Okay, so when we talk about, and of course that's a weighting that we're on there, but we've already considered that, all right? But so remember, in every standard deviation of every measure of risk for every portfolio, you have to have the individual risk number, you have to have how much you have of it in your portfolio, and you have to have the various indicators of co-movement amongst all the pairs in your portfolio. So this is a pretty straightforward example because we only have two assets, asset A and asset B. All we need is standard deviation of A, weight of A, standard deviation of B, weight of B, and then how A and B co-move or are correlated. If then we had a third one, we would need standard deviation of A, standard deviation of B, standard deviation of C, how A and B move together, how A and C move together. So you can see that this gets to be a pretty involved process with a lot of assets, okay, a lot of assets. So let's walk through just a straightforward calculation, okay. Let's suppose we've got a portfolio, 30% invested in stocks. There's a standard deviation of 20%. The remainder is in bonds, standard deviation of 12%. Well, right away, you should recognize if it's 30% invested in stock, the remainder is in bonds, that means what? 70% in bonds, right? Because you have, 100% of anything has to equal 1, right? You can't have more than that. So whenever your boss asks you, are you putting in 110%? You can't put in 110%. You only have 100. Well, I guess you could borrow, but let's not talk about that right now. Okay. All right, so from that, all right, the correlation of the bond and stock returns is 0.6. We already know the standard deviation, so we don't have to calculate the covariance. We just plug into the formula. All right? We just plug into the formula. So here is the standard deviation, right, of stocks, okay, and then the weighting of stocks, and this is the standard deviation of bonds, and then the weighting of bonds. And you say to yourself, well, where do you get that from? Well, 1 minus 0.3 equals 0.7. Okay, and then we multiplied 2 times the weight of the stock market and that's the weight of how much we have invested in stocks and the weight how much we invested in bonds, and then the correlation, okay, and then the standard deviation of stocks and then the standard deviation of bonds. It's plug and chug, ladies and gentlemen, a straightforward calculation. Turns out, that the portfolio standard deviation here for these two assets, between stocks and bonds, is 12.9%. One of the things that you should recognize, is that what is the correlation here? What's the correlation? The correlation is 0.6. It's less than perfect positive correlation, right? I mean, it's less than perfect 1.0, or it's less than positive 1.0, which stands for perfect positive correlation. Okay? If the stocks and bonds were perfectly positively correlated, you would see a standard deviation of the portfolio of 14.4%. A rule of thumb that you should recognize and you should keep in the back of your mind whenever you're talking about portfolio risk and return is that anytime you put two assets or anytime you can add an asset to an existing portfolio that's not perfectly positively correlated with the existing portfolio, the standard deviation is going to go down. It's going to be reduced. That, ladies and gentlemen, is what we call the magic of diversification. All right? The magic of diversification is nothing other than an indication. It is that if you can combine assets in a portfolio that are not perfectly positively correlated, you get to reduce risk. And you might not even be changing return, but you get to reduce risk. Right? So we see that. Okay, we see that in this next slide. Let's suppose we have two stocks. Okay, we've got stock A and stock B. 100% invested in stock A gives us this dot, and I say this dot, I mean essentially this is the point on the what? Expected return standard deviation graph. Okay, so this black dot represents that we have expected return of stock A approximately approximately 25%, and standard deviation a little bit north of 20. Whereas stock B has expected return a little bit north of 10% and standard deviation about 16, 15 point something, right? Well, if we were to combine, stock A and stock B, we have to make assumptions about their correlation. Well, technically we could do and formulate the calculation, but for illustration purposes, what we're doing here is doing nothing other than I'm investing all of my portfolio in stock A or all of my portfolio in stock B. If I combine my portfolio into stock A and stock B, that means I need to do some proportion. I'm investing in stock A, and the rest of that I'm investing in stock B all the way until I'm fully invested in stock B. Or alternatively, I'm 100% invested in stock B, I take a little bit away and I invest in stock A, and I work all the way until I get 100% in stock A and stock B. If those two assets are perfectly positively correlated, what we see is that the expected return and standard deviation of that portfolio is a linear, it's a straight line between the two. Okay, straight line between the 2 points. So technically, there is no benefit of diversification when you have perfectly positively correlated assets. Why? Because at this return, at this level of return, essentially the standard deviation is nothing other than a weighted average of the standard deviations of stock A and stock B. However, if the two assets have less than perfect positive correlation, okay, and in this case here is an example that the two assets have a positive correlation coefficient of 0.3, or what some people would say a 30% positive correlation. I tend to stay within 1 and -1, correlation 0.3. Okay, essentially what do you get to do? You can still form a portfolio, okay, you can still perform that gives you the same return, but look how much less risk you get, okay, look how much less risk you get. And that works all the way down whenever you have different correlation coefficients. So if we have negative correlation coefficient, wow, we can have the same. Now remember, now what we're doing is we're keeping the return the same, but look how much the standard deviation has declined. And I don't know, we'll say somewhere around 18% to almost like 14.8% to a little bit less than 10. Wow. And we're still getting what? We're still getting about 17% return. The risk is going down and down. Now, in the extreme, okay, where we have perfect negative correlation, we can actually formulate a weightings between the two assets that will generate a portfolio with zero risk, or with zero standard deviation and non-zero return. All right, so that's an extreme example. So what you should recognize is that a perfect negative correlation and a perfect positive correlation, relatively occur in nature. Okay, relatively occur in nature. It's kind of like this, I don't know, a goose that lays the golden eggs. It just doesn't occur in nature. Doesn't mean that we cannot create assets so that they generate those characteristics. It's just that generally speaking, assets rarely do they move in perfect opposite, or rarely do they move in perfect lockstep. Okay, so from that aspect, what I'm trying to get you to understand here is that as long as you can put together assets that are less than perfect positive correlation, i.e. assets that have a correlation coefficient less than 1.0 positive, you will receive what we call the diversification benefit, meaning that you can maintain the same return. With lower risk. All right. So if we discuss, or we hit, if I hit you with this question, is that an asset has correlation with a portfolio's return that is less than 1, and let's think of that as being less than positive 1.0, but has the same standard deviation of the returns as the portfolio. What effect will adding some of this asset B to the portfolio have on the portfolio risk? Well, the rule of thumb that I gave you was what? Okay, if you combine assets that are less than perfectly positively correlated, you get what? You get a reduction in portfolio risk. So the answer to this question is, that the overall portfolio risk will decrease. And we're not even paying any attention to what's going to happen to the return. Okay, we're not paying any attention to the returns. We're just focusing right now on the risk. And that is the beauty of diversification. Okay, that's the beauty of diversification. What we're going to do now is we're going to stay in that same mode, all right, to stay in the same mode of what would happen if we were to do a bunch of calculations on a bunch of different weightings on a bunch of different assets. What kind of graph would we get? Hey, what kind of graph would we get? Well, what we're going to see here, now I want you to remember a couple of things. I want you to remember a couple of things. Is that we are working in what we call expected return and total risk or standard deviation space. So think of right now, and for the rest of this section in this part here, we're going to stay in this expected return standard deviation space. And the reason for that is we just want to maintain the same axes so that you don't get too confused, because later we're going to make some shifts and make some assumptions. But right now, let's just stay in this space, all right? So each one of these dots, okay, each one of these dots represents what? Various combinations of assets and their risk return, their standard deviations, and their correlations amongst all the different assets in that portfolio, right? So each one of these dots, think of that as being a, think of each one dot as being a portfolio, okay? Well, what will happen is that you'll see a bunch of dots, and I'm going to try not to be too artsy here, but you'll see a bunch of dots that'll start to bunch on what we call the frontier. Okay, what we call the frontier. Well, there's all kinds of different names for frontier. The specific frontier I'm going to be talking about is the minimum variance frontier. That is, if you go to the left, okay, on standard deviation axis, i.e. on the x-axis, there will be a portfolio that has the smallest standard deviation. The issue is that not only will there be a portfolio that has a smaller standard deviation here, but there'll also be a portfolio that has a smaller standard deviation up here. Which one will you want? Well, this expected return is, 7%, and then this expected return is 17%. Well, we've already kind of indicated that a risk-averse investor is going to is not going to want this one, but is going to want this. So in the minimum variance frontier, that is all portfolios that generate the least variance at every level of return. Okay, so on the y-axis, you stay on one number and you look across the portfolio that has the smallest variance is the minimum variance portfolio. Okay, all right, but we get kind of an ellipse. That's really the geographic shape there, right? It's a half ellipse kind of thing. So that means that we get minimum variance portfolio on both the top and the bottom of the ellipse. Well, we don't want the ones down here because we have the opportunity of having another portfolio that generates a greater level of return. Those particular assets, now I'm going to clear this off here just to get rid of this chicken scratch. Those assets, those portfolios that are up here on the minimum variance frontier, okay, on the minimum variance frontier that are at the top of this ellipse, half ellipse, okay, we will call that the efficient frontier. And all of the portfolios on the efficient frontier, we will say are what? They are efficient in that they generate the highest return, okay, they generate the highest return of all portfolios at their designated levels of risk, okay, their designated levels of risk. So I would just say A, B, and C. Well, portfolio A is efficient, okay, portfolio A is efficient because it generates the highest return at standard deviation 12. Portfolio B is also efficient because it generates the highest return at standard deviation 15, and portfolio C is efficient because it generates the highest return at standard deviation 22, whatever those numbers are. I'm just making those numbers up. You don't need to know those numbers only because of the standpoint that what you should recognize that at any point on the risk spectrum, the standard deviation spectrum, if you go up, i.e. in return, if you stay at that level, the portfolio that generates the highest level of return is going to be the efficient portfolio. All right, there's a couple of different pieces. All right, so that's efficient, and they dominate all others, meaning that these portfolios within the frontier are inefficient in that the standpoint is that all we have to do is just change how much we hold of those stocks or hold of those assets, and we can get a higher level of return. So we never want to hold them because at that same level of risk, i.e. 12%, we can get a portfolio that generates a higher return, portfolio A. There's another piece here called the global minimum variance portfolio. That is the portfolio that has the smallest variance of all portfolios that are attainable, in the investment opportunity set. There's another piece that I want you to recognize here, these unattainable portfolios. You don't see dots out here, do you? Okay, why? Because those assets don't exist. Okay? Those portfolios don't exist. We cannot make combinations. Okay? We can't make combinations of portfolios. Okay? We can't make combinations of portfolios that that will generate dots outside there, because if we could, then what? The frontier would move out. Okay, so anything outside of the frontier are what we call unattainable. Right. So what you should recognize, and I spent this a lot of time on this definition of the efficient frontier. It's a set of portfolios amongst all possible portfolios of combinations of individual risky assets that offer the highest expected return at each level of risk or standard deviation. So think of the efficient frontier as being those assets that give you the best bang or the best reward per unit of risk that you're taking. All right, so think of it that way, and we'll talk more about that. We'll talk more about that later in part 2. But for now, and there's a special name, and I apologize for skipping that over. That efficient frontier is attributable to Harry Markowitz, who wrote a paper back in the 50s explaining and generating in mathematical form how those efficient portfolios are created. And so what we tend to attribute this particular type of approach of portfolio management we call mean variance portfolio optimization, essentially what it is. We call that the Markowitz efficient frontier. So when you think of it, which assets are going to be on that top line? Okay, which assets are going to be on that top line? Well, this particular problem says, which of the following portfolios is least likely on the Markowitz efficient frontier? Well, we have expected return 10, standard deviation 12, expected return 12, standard deviation 16, expected return 14, standard deviation 15. One of these is out of place, okay? And one of these is out of place. And technically it's going to be B, and you say to yourself, well, wait a minute, why is that? Okay, how do you know that, John? How do you know that? Well, the reason why is because B has a lower return but a higher standard deviation compared to C. It has a higher return and a higher standard deviation compared to A, so we really can't make a distinction about that relative to A, because it has a higher return and a higher standard deviation. Okay, but compared to B, it has a lower return but a higher standard deviation. So we know that it's in, quote unquote, it's an inefficient portfolio. It's within, okay, those portfolios that are dominated. All right. So if we I have a couple more slides left, and this is going to set excuse me, this is going to set up. I get choked up by this stuff. I like this. It's going to set up our discussions for when we get into part 2. Okay. And I know some of the stuff looks pretty mathematical, but try to keep things simple. Okay, try to keep things simple. The first thing I want you to remember, we are staying in expected return standard deviation space. We are still there. Okay, we're still there. Now, so we're not making any adjustments. We're not doing any mathematical mumbo jumbo. It's just think of a y-axis and an x-axis, and the y-axis being expected return, the x-axis being standard deviation. All right. So let us suppose. Let us suppose that we have a risky asset. All right, we have a risky asset. And we're not going to, at the moment, we're not going to, that risky asset could be a portfolio or it could be a single asset. Don't get too worried about that for right now. But this risky asset generates this expected return and standard deviation, okay? Now, let's suppose we have that risky asset and then a risk-free asset, i.e. an asset that generates this return but no standard deviation, right? No standard deviation. What we're going to be doing, is investing, so this is 100% in the risky and this is 100% in the risk-free. What we're going to be doing is investing a little bit less than 100% in the risky, some in the risk-free, a little bit more in the risk-free, a little bit more in the risk-free. And in this particular case, let's just suppose that we're sitting right here. Okay? And I don't know what this number, let's just suppose that's the weighting. Let's just say it's 70%. Okay? It doesn't matter what the number is, because what you should recognize is that whenever you combine a risky asset with a risk-free asset, you get a linear, straight line connection between the expected return standard deviation trade-off. And you ask yourself, why? Well, technically what? The standard deviation of the risk-free portfolio is what? It's 0. Okay? And the covariance of the risk-free portfolio with the risky asset is also 0 because it's not moving no matter what the risky asset is doing. So you have a linear combination in expected return and a linear combination in standard deviation. Where that standard deviation of the portfolio is nothing other than, look at that, look how simple that formula is now. It's just the way how much you have invested in the risky portfolio. How much you invested in the risky portfolio. This combination, this relationship is what we call the capital allocation line. When we combine a risk-free asset with a risky asset of portfolio, that risk-return trade-off, or that risk-return combination, is referred to as what we call the capital allocation line. Okay? And the expected return is a weighted combination of the expected returns of the risk-free and the risky, but the standard deviation of the portfolio is just how much we have invested in the risky portfolio. So from that aspect, you say to yourself, well, okay, what does that mean? Well, yeah, okay, one of the things that we have to recognize, is that various investors have various levels of risk aversion, they have various utility functions, they have various preferences, etc., etc. So whenever we're talking about, making optimal choices, between different investors, we really have to take into account that investor's utility curve. And that's what's really being represented here. Well, whenever we say this IA and this IB, these are what we call ISO utility curves. And at that standpoint, we get the same utility for investor A along this line, and we get the same utility for investor B along this line. What you see is what? You see that investor A's utility curve is kind of to the northwest of investor B. Well, investor A is essentially what we call more risk averse than investor B. He has a steeper indifference curve. His quote-unquote, he's indifferent between utility amongst all that line, but it's steeper and it's shifted to the left. And specifically, it's also shifted to the northwest in this space. Remember now, we're staying in expected return standard deviation space. All right. So when we're thinking about, a capital allocation line, and let's just suppose that this line is being generated. This line is being generated by all risky available portfolios out there and the risk-free asset. And this line that you see here, this line segment AB, essentially is making a connection to that risky portfolio out here. And let's not worry about that right now. But what the idea is that investor A, because they're more risk averse, will choose, investor B is less risk averse, investor A is more risk averse, and what you'll see is that investor B will choose a portfolio that generates a greater return, but yet generates a higher amount of risk, where investor A is choosing a portfolio that generates less risk, but also less return. So when we think about these optimal choices for individual investors, really what we want to be able to do is to maximize investors' utility. And you say to yourself, well, John, why don't we choose a portfolio up here so I can get higher utility? Well, the problem is that what? We don't have any portfolio. These are unattainable portfolios. They're not there. They don't exist. They don't exist. So we can't choose that. We can only choose the set of portfolios and of what's available in the marketplace for each particular investor. So at this stage, we're going to go ahead and stop the part one of the portfolio risk and management. But before we leave, I want to just kind of do a little wrap up. Basic return calculations, arithmetic, geometric calculations. Think of return as being this total concept of both a change in the value and a flow. We've just pretty much assumed no flow here in this section up till now. All right, we've made definitions about various return measures. Think of having a real fat return, and we take pieces off of it, and then we go to the basic metrics of portfolio: mean, variance, standard deviation, which is they're the same. covariance and correlation. And what we want to be able to do from a portfolio perspective is to try and put together various assets to create a portfolio that will optimize our investors' choice, optimize investors' investment decisions. And we want to be able to do that using his utility. He likes return. They're risk-averse investors, right? He likes return, and it's not that he doesn't want risk, but each individual investor is going to have a different level of risk aversion, okay? A different level of risk aversion. So whenever we calculate that, when we formulate the expected return or standard deviation of a portfolio, we can then help individual investors make those decisions. Another thing to remember is that as long as you have an investment or an asset that has less than perfect positive correlation of existing portfolio of assets, you can do what? You can benefit from diversification by adding that particular asset or portfolio or asset to the existing portfolio, because what happens? We reduce risk. If you have an asset that has less than perfect positive correlation, okay, you can reduce the overall risk of the portfolio by adding that asset to the existing portfolio. And you will see that whenever we talked about the mean variance frontier, when we talked about the efficiencies of the portfolio. When we talk about efficient portfolios, those are the portfolios that generate the highest level of return given any unit of risk. Okay? And that we always choose those as opposed to those that are inefficient. So for right now, let's go ahead and stop and take a break, and then whenever we come back to part 2, we'll get into a little bit more details about the capital allocation line, the capital market line, and the security market line, etc. But that's it for right now.